One of the things I want to ask you about is the role of bonds in a portfolio. So basically, bonds have been a great diversifier for stocks in the long run, and typically they're offering investors some type of yield as well. So investors get paid back in most cases. But with rates where they are, some have argued that bonds basically you shouldn't even be holding bonds in your portfolio because if you have any inflation, you're probably going to lose money on them. But what are so do you have any thoughts on sort of the use of fixed income and bonds in a portfolio starting today?
Yeah, I mean, several thoughts. One is the most obvious, which is the bonds. I mean, bonds are in the portfolio to stabilize a portfolio, right? I mean, if no one cared about volatility, you probably would just have an all stock portfolio. Given everything we know about, again, the equity risk premium and so on. So the first question I think for investors is, how much volatility dampening do you want? In other words, how much risk do you want to take? And to the extent that you want to take less than the amount of risk that is going to land in your lap by virtue of having an all stock portfolio, you really have no choice but to inject some bonds into the portfolio. The second thing is, I think just given the environment, we just have an unpalatable choice in front of us. You can either reach for, if you don't like what sort of safe bonds are giving you, you can take more risk and reach for yield. But understand that you're taking more risk there, or you can just be more conservative and take less yield. I don't know that there is necessarily a free lunch there. You're just gonna have to decide what's more important to you, yield or low risk. Right? Okay, so there's that. Having said all that, I think there's one interesting wrinkle in this particular bond market that I think is underappreciated. And that is right now, let me take a step back for a minute. The bond markets, there are some esoteric premiums built into bond markets. I don't think we need to get into those necessarily. But the big two are term risk and credit risk, right? The longer the maturity, the more you expect to get paid, assuming it's an upwardly sloping curve. And the less creditworthy the borrower, the more you expect to get paid. That's the credit rate. So term and credit. It happens that in this market, the credit premium is way higher than the term premium. If you look at what's happened to term, just look at treasuries, for example. The difference between buying a 2-year treasury, 10-year treasury, you're not going to get paid a lot of money. But the difference between buying treasuries and buying high yield bonds is huge. It's like 400 or 500 basis points. So what does that mean? What that means is you have an opportunity if you want it. If you're just buying the broad bond market, let's say you're buying the ag. If you're buying the ag, you're getting a yield of say 110, 111, let's say 110 basis points roughly, and you're getting a weighted average credit of, let's say, credit rating of AA, let's just say. So you can take that if you want. But you can do something different. You can say, okay, since I'm not getting paid term, instead of buying the ag, I'm going to disaggregate the ag. And I'm going to buy the ag and its components only short term. So I'm going to buy short-term treasuries. I'm going to buy short-term corporates, investment corporates, and I'm going to buy mortgage-backed securities. And instead of getting a 6 duration, you're going to take roughly a 2 duration. And then, in order to make up for the yield, because your yield is now going to go down from, let's say, 110 basis points to roughly 40 or 50 basis points, you can just inject a little bit of high yield, 10 to 15% of a yield play, say preferreds, maybe a combination of preferreds, maybe emerging debt, maybe U.S. high yield debt. And what you'll end up with is a portfolio that has the same weighted average credit rating, a AA, again, weighted average, and a yield that has roughly the same as the ag, 110, 120 basis points, only with a lot less duration. So what have you done? You've got the same yield, you've taken less term risk, and you've taken the exact same credit risk. That is a free lunch. And it's a free lunch just by virtue of the fact that the term premium just happens to be dwarfed in this moment by the credit premium. That's not going to last forever. If you don't want to keep an eye on this stuff, I would say don't even bother with what I've just said. Buy the ag and forget about it and leave it alone.